So my name is Michael Scepaniak. I am retired. I'm not too familiar with Dave Ramsey, Choose FI, but my focus of retirement reading has been Mr. Money Mustache, Early Retirement Extreme, Mad Scientist. So I heard about the Choose FI group through the Mr. Money Mustache forum. I joined, and then that was still relatively early before the heady days of 500 members. And it was, I think Alex posted, hey, new members, would you just introduce yourselves? And I posted, it's like, hey, my name's Mike, I'm retired, blah, blah, blah. And Alex reached out to me, he's like, oh, you really should come to the meetups because you're actually retired, like that's really cool. And I said, yeah, I don't know. I live in Cockeysville, it's in Elk Ridge, that's a long way away from me. I don't really feel like going all that way down there. And I think Alex actually said, no, you really should come. What if I like gave you a few bucks or something? It's like, no, you're not gonna, no, that's ridiculous. But hey, how about if we carpool? It's like, oh, okay, fine, let's carpool. And that's how I actually got. So I've been to about every other meetup since then. And this is my lovely Deborah. She's here because she's supporting me and she's gonna be the slide navigator. So I am presenting today, as you obviously can see. So again, my name is Michael Scepaniak. I'm 44 years old. I retired on January 1st of last year, 2018, so I was 43 at that point. So I've been retired for about a year and a half now, a little more than that. And I'm still getting used to it. Still getting better at it as I go along. And I am both FI, financially independent, and fired, financially independent, retired early. And today I'm going to be presenting on retiring early on stock dividends. And I have mentioned at various meetups when the discussion turns to it, I will mention dividends. And amongst the FIRE community, dividends is not the main thrust that you'll hear about. It's a bit of a fringe approach, and I just feel that it's worth discussing a little more. So amongst the people here, just raise your hand if you invest actively in the stock market to some degree. Okay, great. Because amongst the FIRE crowd, it's either stocks or real estate. It's kind of one or the other. And amongst you, how many of you invest in dividends or for dividends? Okay, it's pretty small. Good to know. Okay, so by the end of this talk, my goal is that you'll have a viable option for investing in the stock market other than total market indexing. Okay. Now my goal, I am not trying to discredit indexing. I think that indexing is fine. Total market indexing, great. All I'm trying to do is present an option. That's all I'm trying to do. Okay. Next slide, please. Okay, so this is our agenda. I'm first going to go over just some basics of dividends, just to make sure we're all on the same page with our understanding. Then I'm going to go through why dividends, basically the arguments for dividends. Then I'm going to go through some nuts and bolts about how you would go about constructing a portfolio based on how I do my portfolio. Then we're going to go into just discussing REITs and MLPs. Might be fairly foreign topics to some people.
Define them real fast?
Yeah.
You mind defining them real fast?
I will when I get to that.
Okay.
And if anyone has any questions as I'm going through this, please just raise your hand. I'm fine with that. And then I'm going to wrap up with arguments against this strategy. So I'm going to try to approach it from both angles to give a very even thrust. I'm not trying to create converts here. I'm just presenting an option. There's warts to it, and there's also some non-warts. Next slide, please. Okay, so I live off dividends, period. I live off dividends that are paid out by individual stocks I hold in a taxable brokerage account. Okay. So let's define what dividends are. So a dividend is a payment made by a corporation to its shareholders, with each share receiving an equal amount of value. Plain and simple. Now, in practice, the vast majority of dividends are regular cash dividends. They're paid at predictable intervals. And in the United States, that interval is typically once every 3 months. So a typical metric for quantifying and comparing the dividends of various companies is the dividend yield. And that's represented as a percentage. And it's easy math to do. You typically just take the annual dividend rate paid by the corporation, and you divide it by the stock's current price. Okay? So if you had a stock that is worth $100 a share, and the dividend rate is $4 a share, the yield's going to be 4%. You just divide the rate by the stock price. And that's dividends 101. Okay, so now we're going to move on to arguments for why you would want to go with a dividend investing strategy. So I hold dividend paying stocks because I find them to be my best option for earning passive income from my savings. Income. So this is in contrast to the prevailing opinion amongst the FI community that favors total market index-based investing through mutual funds or ETFs. And those are typically offered by Vanguard. Vanguard is the favored provider of those mutual funds and ETFs amongst the community. So there are roughly 7 reasons why I invest for dividends. And I broke them up into these 7, and I'm going to go into each one of these. So I find that the income thrown off through dividends, are substantial, stable, consistent. They're inflation aware. The income is tax advantaged. It's easily harvested, and it's low stress. I'm going to go through each one of these. Okay, so reason number 1 why I invest for dividends like I do. So for those stock market investors here who invest in VTI, VT, and SAX, so it's a fairly popular option. So VTI, that's Vanguard Total Stock Market ETF. The yield on that is around 1.81%. VTSAX, that's essentially the mutual fund equivalent of that. That's Vanguard Total Stock Market Index Fund. Similar yield. My yield, by my calculations, which might be a bit of a different methodology than you'd find from a standard ticker, I calculated to be for the first 6 months of 2019, my yield was about 4.08%. And according to my broker, going forward through the next 12 months, I stand maybe 4.72%. Again, I'm not exactly sure how they're calculating versus I'm calculating, but the bottom line is that there's a quite significant difference in dividend yield between what you're going to get from an index, mutual fund-based index, and what I'm doing through my strategy. And this is how I'm trying to maximize, and this, I call this substantial in terms of income.
But you're going to show why that's not the total return from VTI, obviously. I mean,
no, that's not the total return.
Yeah.
And I want to stress that's a very good point to make. This is income. I'm talking about substantial income. In terms of total return, that's a different animal, and I'm going to go into the fact that I really want to stress that I'm focused on the income portion of this, and I'll explain why. Okay, reason number 2 why I invest for dividends the way that I do. And this slide demonstrates, all I did was I took, this is a canned graph that I just took from a publication. So this is for Caterpillar, this is a public stock, and this is the history of the blue line, which is the stock price, versus the red line, which is the dividend rate. And you can see this is from 2000 up until 2018, so this is quite long time. And what you'll see is that the stock price of Caterpillar and most every other stock in the world is basically yo-yoing up and down on a constant basis. Daily, minute, weekly, yearly, whatever time frame you want to focus. But the dividend rate is relatively stable in comparison to the stock price. And there's a lot of stability to be gained from this in this stair-step fashion. Both are trending up, which is great, which is what you're going to want. But in comparison to the stock price changing all the time, the dividend rate is relatively stable, which is nice to have. Now, of course, dividend cuts do happen. In this, there has been no dividend cuts. When you have a cut, it's going to be very significant, and I'm going to go into dividend cuts later on. Reason number 3 why I invest for dividends like I do, and is consistency. Okay, so my monthly dividends payments earned for the past 6 months, these are the amounts. $1,800, $4,200, $4,400. I've laid it out here for you. So these payments are not as consistent as you would get from a salary. If your salary is this every month, you find this to be a little discombobulated. But when you're talking about income thrown out to you from investments, this is relatively consistent because you're getting something every month, and it's always positive. You're never going to go below 0 with dividends as compared to your valuation of the actual underlying assets in the stock market. Next slide, please. And in terms of consistency, dividend payments are scheduled. In the US, it tends to be every 3 months. And I don't know if you're necessarily always going to know the exact date, but you're going to know the range of when they're going to be paid out to you. So you can actually mark your calendar if you want. So here's just a few companies. We've got Johnson & Johnson, Lamar & Lloyd's. So for example, Johnson & Johnson is paying every 3 months. The next payment is going to be mid-September. Lloyd's is a non-US stock. That's a British company. So they kind of buck that trend. They just do 2 dividends twice a year. In this case, Pfizer, it's actually going to give you the exact dates. Others are going to be more ranges. There's at least one stock that actually pays you every month, which is great. Next, please. Reason number 4, why I invest for dividends the way I do. And it's because they're inflation aware. So, not inflation proof, but inflation aware. So a worthwhile dividend paying stock, or any stock really, but especially dividend paying stocks, they grow at a rate that is some degree greater than inflation. That's a sign of a good company. Now, in corollary to that, the dividend rate for those companies rises in a similar fashion, which is faster than inflation. Now this is based on, typically, that company, those companies, having some sort of economic moat. Is anyone here, are people here familiar with the concept of an economic moat? Would you like to explain?
Oh, well, it's just Warren Buffett's expression for something that gives a business a unique value. Like a moat around a castle made it hard to storm the castle. I'm not sure why he thinks there's a moat around Coke except for the brand, but it's his expression for, so I'm not sure how you're using it here, except that if you're investing in these types of companies, the expectation is that they will continue to grow at least fast enough that their dividend keeps up with inflation.
There's either the startup costs or legal issues make it hard for somebody to enter competition with that company. That's the moat.
Yep.
And they'll use both strategies, so regulations and stuff. Sometimes they'll use just the fact that the brand name, like Coke maybe, makes it very hard for somebody to knock them off.
It's essentially a competitive advantage.
Yeah.
That can prove durable to one degree or another. Thank you. So the growth of a company and the underlying dividend over a long time frame tends to derive from these moats, and it basically insulates the company's profits. Now, however, just as the performance of a company and the fundamentals can strengthen, over time they can also weaken. So growth and the dividend rate can weaken over time. Nothing's guaranteed. Next, please. Reason number 5, why I invest for dividends in the way that I do. And it's that they're tax advantaged. So the tax rate for qualified dividends, for currently for single filers is 0% if your income is less than $38,600. For married, $77,200. So that's 0%. You don't pay any tax on qualified dividends up to that income level, which is great. Now, the same policy applies currently for long-term capital gains. So there's nothing different there, but the point I'm making is that they're on a level playing field, at least they are right now, based on the tax code, which is great.
That's federal only, not state.
Yes,
Yeah.
federal level. Yes, very good point. Thank you. And it's going to vary state to state, of course. And I will just make a quick comment here, just for completeness, is that MLP income is tax-free, 100%. I'm going to get to that more in detail later on. Yes, question?
So just to clarify, I think when you say a 38 number for single, that is after the standard deduction. So really, if you're up to like 50, and that's your only income, of course, then it would be 0.
Yep.
What is MLPs now?
I'm going to be going into that in more detail.
Are you also going to go over qualified versus
Yep.
non-qualified?
Yep.
Okay.
Yep. Anything else? Great. Reason number 6, why I invest for dividends like I do. So I live off of yield only. I don't touch principal to account for my living expenses. So I don't have to sell anything to provide my income. And this is why I say it's easily harvested. It just comes to me. I don't have to make any decisions or take any action to do any selling on a regular basis to earn my passive income. Okay? So I find this to be great because, well, if I asked anyone here, who here feels that they need to sell off their possessions on a regular basis to achieve, to account for their living expenses? Oh, really?
Yes.
But you're the only one.
Is that the secret, Dan?
Selling off your possessions.
Yeah.
The dirty little secret of early retirement.
Right, yeah, my dividend yield is much lower than yours, probably around 1.6. I have a lot of non-dividend income, or non-dividend paying assets that I own. So it's a different strategy. So. But because, like you said, how capital gains work exactly like qualified dividends, it's almost the exact same tax benefit we get. So.
Okay, reason number 7, the last reason why I invest for dividends the way that I do, and comes under the heading of low stress. And I'm going to be on this slide for a little while because there's a number of facets to this. So who here is familiar with the 4% safe withdrawal rate? A lot of people. Would anyone like to explain it in a nutshell? Okay, then I'll do it. So the 4% rule is a rule of thumb used to determine how much a retiree should withdraw from a retirement account each year. So this rule seeks to provide a steady income stream to the retiree while also maintaining an account balance that keeps income flowing through retirement. Experts consider the 4% withdrawal rate to be safe, as the withdrawals will consist primarily of interest and dividends. And there's variations on the 4% rule. If you want to be more conservative, you say 3%. If you want to be a little more zealous, you can say 5%, but the concept is still the same. You're focusing on a certain percentage of your assets, of your portfolio that you can safely spend down. So I abide by that rule. I think it makes a lot of sense. I abide by it on yield alone. So my 4% is just on dividends. If you have a lower yield, you're doing some selling to abide by that rule. If the index investors' principal is the same as mine, so we have the same balance on our savings, but their yield is lower, they will need to sell shares to reach that 4% withdrawal rate. And I would contend that this introduces a certain amount of risk and stress. So when selling, the fluctuating valuation of the income investor's portfolio becomes a concern, despite all the wisdom that says it shouldn't. Just psychologically, so for some people more than other people less, still could be a concern. So for example, if the market loses 20% of its value for 1 year in time, what previously amounted to a 4% withdrawal rate becomes a 5.3% withdrawal rate. If the market loses 50% of its value for 1 year, that 4% withdrawal rate becomes 8%, which can seem fairly significant. Now, technically, for my investment portfolio with a 4% yield, in those scenarios, say the market goes down by 50%, my withdrawal rate, yeah, technically it's 8% along with everybody else, but it's always still, assuming no dividend cuts, it's still only yield. It's no principal. So on paper, yeah, it's 8%, but it's different because it's still never touching, I'm still never selling, I'm still never drawing down anything in terms of assets. So it's different, but in a good way. At least I would say. So bottom line, I feel that I have almost no reason to worry about outliving my money, regardless of time span. If you're only ever touching that yield, you're not drawing on the principal, it's a pretty good place to be. So the index investor may choose to increase their amount of principal so that a 2% yield results in more income, but that's going to delay your FI gains if you choose to go that route. Now, with all this being said, the index investor, if the index investor just chooses to focus on total return, not just income, but total return, which includes both capital gains and dividends, the studies seem to show that they'll be okay. And I don't dispute this. I'm not trying to discredit total market indexing. This is just an option. So also the index investor can set up a managed payout to remove some of the psychological difficulty from pulling money out of markets regardless of the conditions. So another aspect of low stress is the transition into retirement. And with the strategy that I'm pursuing, it allows for a seamless transition, which I think there's a lot to be said for it. Having gone through the process, I think it's something to consider. So let's assume an investment portfolio with a 4% yield, which is my portfolio. Okay. Pre-retirement, any dividends that I received, they would get deposited into my account. They would stay there for eventual reinvestment into more assets. Sooner or later, they would go back into the market. Post-retirement, I receive those dividends, that cash in the same exact fashion, but I am no longer reinvesting them. I'm transferring them out to a checking account, and I'm living off of them. So that's what I would call a seamless transition. The money's coming in the same, it's just getting redirected to a different place, pre-retirement versus post-retirement. So for the index investors in the audience, I would ask, how often do you sell your shares?
Could I make one clarification on the
Yep.
4% rule? It does not assume that you're 100% invested in the stock market. It assumes the ideal percentage in the Trinity study was 78-22, where you're 78% in the stock market and 22% in bonds. So I mean, many people, particularly younger, when you are in the accumulation phase, you could be 100% in stocks, but nobody in retirement, except big earn, is going to be 100% in stocks. So when you talk about the stock market falling 50% in 1 year, that would be 78% of your portfolio, but the bond percentage of your portfolio, in times of low inflation and well-run government, bonds and stocks are counter-correlated and move in opposite direction. Where the 4% rule is failure being defined as running out of money after 30 years, has been times like the late 1960s and early 1970s where we had high inflation in stocks and bonds. When stocks fell, bonds also fell because their yield wasn't as high as the inflation rate. But so I don't disagree with anything you're saying, but I did want to point out that not many people in retirement are 100% invested in stocks, and the actual 4% rule that you're citing, the 3 different studies have all assumed a stock bond allocation, not 100%.
That's a good point to make, and I do agree. I am glossing over, when I say stock market, I really mean financial markets. It's just stock market is an easier.
Right, but that's where the stocks
way.
and bonds aren't. When stocks go down, typically bonds, the value of bonds.
Now, with that being said, I am 100% equities. I am 100% stocks. So,
Right.
just to clarify that. Clint?
One other minor clarification. The way the 4% rule study was defined and the way people talk about it, the first year that you start living off the investments, you peg 4% against whatever your portfolio is. You then adjust that number for inflation every year upwards. It's not take whatever the portfolio is the next year and multiply that by 4%. You actually set yourself on a scale to live. And the point being, with the proper allocation in most 30-year periods, you will not run out of money. And in fact, most 30-year periods, you end up with much more at the end of the 30 years than you started with. That's why it's a safe withdrawal rate.
I had a question that's kind of a series of short questions for you. I'm curious about it if you feel comfortable. So I saw the numbers that you put up about dividends, so it looks like you're going in low 40s?
Yep. Yeah, high 30s. Yeah.
High 30s, low 40s. And like I was saying earlier, you could go up 50 and still be zero federal. I'm curious what your state tax rate is, because you're on the low end compared to a lot of people.
Off the top of my head, I don't remember the percentage. I think it was 2.3 something.
Between state and local, I should say.
Yeah.
Yeah, I think it was like 2 point something.
So very
It
low.
couldn't be much.
Yeah.
Very low. So I'm curious, do you harvest any of your long-term gains, because you'd be doing it at like 2 or 3% for 5,000 or 6,000 at least?
Yeah, that's the goal. So I've only been doing this for a year. So the first year I did have some capital gains, but I wouldn't say that I was at a point where I had enough of a buffer to be harvesting.
Mm-hmm.
But we can get into that more detail later on. Any other questions? Okay. Let's see, where was it?
How often do we sell stock?
Oh yeah, yes. So thank you very much. So the rhetorical question was essentially, how often do you sell stocks if you're doing index investing? And essentially, there's not a whole lot of selling going on at that point. So in terms of transitioning to retirement, so pre-retirement, if you're doing index investing, in general, you're doing lots of buying and you're not doing any selling. And then as you go into post-retirement, what the assumption is that really for the first time ever, you're going to start selling, which is a new animal. It's a new behavior. It's new and unknown territory, which I would argue is not what I would call a seamless transition. May or may not be a big deal to you. But if I would say that, imagine you're Tom Brady and your team has reached the Super Bowl and you're basically in the week or two in preparation for the game, how would you approach that game? Would you go through the same habits you had been going through the entire season, or would you switch everything up right before that game just because you wanted to or you felt you needed to? I would argue that you would go through the same motions that you were going through that got you there. You wouldn't necessarily switch it up right at the last moment. So amongst the people here, raise your hand if you believe in the wisdom of dollar cost averaging into the market. Okay. I do, I agree with it as well. For those people that are familiar with it, I just have a quote that maybe captures this low stress element in a different way. It's basically that when it comes time to take income, you're put in the position of needing to sell off shares. This works as a form of reverse dollar cost averaging, since you are now selling into a changing market rather than buying into it. That is, you will often be selling stocks at declining prices and locking in your losses permanently. Just a different way to look at it if you're a big dollar cost averaging proponent. So for me personally, the closer that I got to FIRE, the more I stopped keeping track of how my portfolio was performing compared to the market as a whole. That's honest. All I care about now is my yield and my annual income. That's the number that I'm looking at. The actual valuation of the underlying assets, I really don't look at it very much at all, to be honest. So we've gone through the arguments for dividends. Now I'm going to go into some of the specifics about constructing that portfolio that yields those dividends. So, who here holds individual stocks? Good number. That's great. So I hold individual stocks as well. I hold stocks that pay dividends that are relatively high, growing, and stable. Relatively. So I hold individual stocks because I find that dividend ETFs and mutual funds, they don't compare very well on those metrics. At least not in a way that is paired with low fees. Because you want to make sure that your fees are low enough so it doesn't eat your returns from the foundation part. So I do not pick my own stocks. I outsource it. I mirror the holdings of the real money Morningstar Dividend Investor Dividend Select portfolio. I have been subscribing to this portfolio since around December of 2007, so I've been doing this for over a decade, so I have a good track record with it, very familiar with it. I do not know enough or care to know enough to properly gauge the quality of a stock's dividend in terms of sustainability and growth prospects. It's not in my wheelhouse, so I outsource it. So the Morningstar Dividend Investor subscription, it costs about $200 a year. So it's not tiny. But I find the subscription cost to be worth the money. And that's essentially when I do the math, it's a good balance. Now, essentially what I'm making the trade-off is that for $200 a year, I earn about $26,000 in extra income. And my math kind of goes like this. If I assume a 1.8% dividend yield from an index ETF, which is what would be my other option personally, and I compare that to a 4.4% dividend yield for a portfolio that performs the way I do, which mirrors this dividend investor portfolio. And if I assume, for simplicity's sake, just $1 million in assets, that $200 a year subscription will gross me this extra amount of money. So for me, that makes sense. If your balance of your savings is significantly less, if you only got $1,000 right now, well, $200, that's a huge chunk out of that. But if you're somewhere in between $1,000 and $1 million, okay, then the sliding scale, this pays off a whole lot more.
Hey, Michael.
Yep.
Do you have a sense of how the dividend investor portfolio has performed compared to the S&P 500?
Yeah.
I know you said you didn't care that much about it, and that's a total reasonable position too.
Yeah.
But just for sake of comparison, do you happen to know?
I'm going to go into that, but essentially it's close.
Oh, okay.
Yeah, it's a few percentage points lower over the
Okay.
course of its history, which is pretty impressive.
Yeah.
Even though I'm not focused on it, it's nice to know.
Yeah.
So it sounds like you have been constructing this portfolio since 2007, and my mind always thinks about why don't you, if I were to invest in this, like build this construction portfolio, why don't I just invest in mostly growth stock and while I'm working, while I have an income, but as I get closer to retirement, then I move more toward dividend, dividend stocks. What do you say about that? Since you invested over time, probably for 10 years before you actually retire.
Yeah, so there's kind of two aspects of that. So amongst ignoring dividends, ignoring indexing, so the two classic strategies for investing in stocks is value versus growth. And before I went full bore into dividend investing, I just picked stocks, and I was more of a value guy. I did some growth investing. I think I bought Netflix early in the days, and I bought Apple early in the days, and then I sold them way too early. My biggest miss. But as far as transitioning from one to the other, I think that's fine. The one concern that I would have is as you're transitioning, you're doing a lot of selling.
Yep.
So you're going to realize probably a lot of gains. Yep. If you're okay and resigned to that fact, then it just comes down to what you got to choose when you're going to want to do that. Personally, I like to establish, as I got closer to retirement, it was stressful. It's like, is this really going to happen? And I got to believe a lot of people have that doubt. There is the one more year syndrome. It's like, I just need one more year to be comfortable, one more year to be comfortable. Glad.
It's totally true.
Glad you can understand that. So I think the longer track record you have with your income producing strategy before you actually cut that cord and you do that retirement step, I think the more likely you're actually going to do it. But that's just me. Maybe you would operate a little differently. Where was I? Okay. The Morningstar Dividend Investor portfolio currently holds around 30 stocks compared to the S&P. Question?
Before we get into that, I just want to make a question at the beginning.
Yep.
Do you have tax deferred accounts as well?
Yes, I do.
Okay.
Yes. So I have them, but I do not try to get anything out of them to live off of.
I understand.
Because you're still in your 40s.
Yeah, it's essentially the same way. I invest in the same fashion. It's a smaller amount, but it's a nice reserve. And I don't really factor that into anything, so I'm not burning that up. So I really focus, I'm not living off of that income, and I'm not trying to do any kind of like conversion ladders or anything from that in any way, shape, or form. But that is an option.
Going back to his point, if you're not doing a conversion ladder or a tax mistake, we need to talk about that afterwards because you're missing an opportunity.
So currently, the model portfolio holds around 30 stocks. I hold around 30 stocks. So this compares this is a much smaller number than if you were doing S&P 500 investing or investing in total stock market, which I think holds 8,000 or so different positions. This number, though, it sits near the midpoint of the ranges that several studies show to be enough diversification. I think one study showed that a number as low as 8 is enough, whereas another showed that 49 is the upper bound of really where you need to be in order to be diversified. So according to those studies, 30 is actually right at the midpoint. Personally, I feel like it's okay. And the fact of the matter is that in order to achieve the yield that I've gotten to, there's really a relatively small number of dividend-paying stocks that meet this portfolio's criteria in terms of quality, stability, growth prospects. So it really reduces the universe, the size of the universe that you can choose from. Now convert, yeah?
When that portfolio obviously changes, so you sell and you mirror it exactly.
Yes.
Okay.
Not exactly. I mean, I still use my own judgment, and I might underweight and overweight a little bit. But over the time, as I've gained more confidence in it, yeah, I just kind of go along.
But if they
with the
drop
ride.
something, that could mean that company's in trouble, and
Yeah,
you're
or the dividend is in trouble. Not necessarily the company, but the dividend.
Yeah,
Because it's investing for income.
Two quick questions. How much turnover do you have per year?
I'm
And,
gonna go into it.
and are they equally weighted on the positions, or are they somewhat
No,
different?
no, it's not equally weighted.
Okay.
But yeah, I'll go into the turnover.
Okay.
So in terms of diversification, conversely, it's interesting to note that the portfolio that I'm mirroring, it includes REITs and MLPs, which are the types of companies that a bunch of indexes, especially MLPs, are intentionally not going to include. So from a certain perspective, it's actually more diversified. Just a point to make. Next slide, please.
Anyway,
Yep.
can you just clarify what that $200 a year is giving you? Is that like the privilege of being able to see what this ideal portfolio is, or is it actually buying and selling for you or making recommendations using your own?
So it includes a monthly newsletter. It includes a website that actually shows the actual portfolio with the nuts and bolts allocations and the purchase prices and the valuations and the relative weighting within the portfolio. They do not do any executions for you. They do have a service that will invest for you, just like the portfolio does. So if you really want to be, if you like this strategy, but you don't want to actually do it yourself, you can pay somebody to do it. I've never looked into that because obviously it's going to cost something, and that just reduces the cost, and I'm okay doing it myself.
And how much time would you say you spend on this?
So typically there's the monthly newsletter, which I just typically save up, and I'll read them on a flight because I don't feel the need to keep up to that degree. But there's typically a weekly email that just goes out that basically will present, oh, here's the latest news on the companies that we hold. Maybe they'll have an earnings announcement or something, or they'll announce a dividend raise or what have you. So it's, in terms of weekly effort, I would say if I really wanted to read everything,
Not so much your weekly effort in reading it, but managing your kind of.
managing it,
Yeah.
very little, maybe 15 minutes every week, and that's if there's some trades. If there's no trades, it's really a matter of just transferring dividends once a month from my brokerage account to my checking account. And that takes about 3 minutes. Yep.
Just one quick question. So apparently, obviously, dividends don't contribute to your Social Security, right? So you're giving up a fair amount. By retiring early, you're giving up a fair amount of Social Security, what you would get for Social Security, and you're okay with that, right?
Yeah, especially for me. I was an independent contractor, so I actually tried to keep my income fairly low for tax purposes. So yeah, I'll get something, but it's not going to be a ton of money. That's not a huge portion of my retirement plan. If anything, I just view anything I get from Social Security as offsetting my medical expenses, which is a nice bonus.
Later, maybe I can ask you about what you do for health insurance now.
Yeah, definitely, yeah, totally, yeah.
So I'd probably respond to the Social Security question. So you don't really get Social Security, you have to put in. So he's not putting in anything, essentially. So he's not getting, but he's not putting in, and it's not a great rate of return. So he's really better off.
But you'll get less Social Security since you retired.
He'll get less, but he didn't put in the money to begin with. So it's a trade-off, and it's probably to his benefit.
Thank you. So now we're going to go into REITs and MLPs. So I have chosen to include REITs and MLPs in my portfolio. So both are optional. You don't have to necessarily include these when investing for dividends. REITs, that's a harder cut. MLPs, you definitely can do without, and I'll explain why you might want to. Okay. So REITs stand for Real Estate Investment Trust. It's just a different category of stocks. These are companies that invest in real estate, typically commercial, and they're organized as a corporation. REITs tend to have higher dividend yields than non-REITs.
Required.
And that's good. But those dividends are ordinary dividends. They're not qualified dividends. So in a previous slide, I said that qualified dividends are taxed at 0%. Ordinary dividends are not. Ordinary dividends are taxed at ordinary income rates for everybody. Now, this is regardless of your tax bracket. MLPs stand for Master Limited Partnerships. And these typically are pipelines, very boring companies, but they're structured in a different way where even what you would say you're getting from them, it's not even necessarily dividends. You're actually, you're not even a shareholder. You're a unit holder in an MLP, and every unit holder will get paid various payments by being a unit holder. So it's even a different terminology. Now, the MLP income is tax-free for as long as the MLP is held. However, as you hold in, I'm going to just talk to some specifics about this. You don't necessarily have to absorb all of it, just trying to give you an overview. The cost basis of your MLP investment will diminish as the MLP is held. So the longer you hold it, so typically when you buy a stock, if you buy it at one share at $100, your cost basis is $100. And it will stay that way. Maybe the cost will go up of the stock. Maybe you'll sell it at $200 a share. Your cost basis is always $100. Great. With the MLP, as you're getting paid out over the course of your holding period, your cost basis is actually going down. So what you paid for at $100 a share, by the time you sell it, your cost basis might have gone down to $50 a share, which means that more of that is going to be subject to taxation when you actually come to sell, which is the problem with owning an MLP. If you never sell it, that's fantastic. You've earned all this income over the course of your life. You die, and then when actually it's finally sold, I'm not exactly sure how that happens. Maybe somebody pays taxes, but you're dead, so why do you care anyway? Is for anyone here, is this the first time, who here is, this is the first time they've ever really even heard about MLPs? Okay. And this might be why, because the MLPs are not included in indexing. They are intentionally excluded because of some of these complications. And that might explain why a lot of people don't even hear about them. Now, also, MLPs,
do they have a standard lifetime, like over 20 years your basis will go to zero, or does it differ by MLP?
The amount that your cost basis will go down is, in general, in proportion to how much income is thrown off. But there's not really a lifetime to it. I've never heard of an MLP expiring because your cost basis went down. It's just that your cost basis could go down to zero. It depends on when you bought it and how long you've held it for. So MLPs are not suitable for tax-deferred investment accounts. I'm not going to go into the details of it. But if you were investing through an IRA or a 401k, you do not invest in MLPs. You just don't do it. Morningstar Dividend Investor, they realize this, and they actually offer a non-MLP version of their model portfolio. So if you're investing in tax-deferred accounts and you're saying, well, I'm screwed because they do MLPs, no, you're not. You can actually do the non-MLP equivalent, which actually isn't that big of a hit. When I actually did the math on it, I looked at the yield on the tax-deferred account is like 4.3 versus 4.4. And actually that was interesting for me to look at because the headaches involved with investing in MLPs, is it worth that 0.1%? Yeah, maybe not. And I might actually take myself out of the MLP.
MLPs give you a K1?
Yes.
I thought.
I'm going to go into that at the end. Arguments. Next slide, please. Which brings us to the reasons why you would not go with this strategy. We're going to go through arguments against. And next slide, please. I've broken it out into about 6 different arguments against going with this strategy. Okay. We're going to talk about fragile company-specific dividend policies. We're going to talk about the costs in terms of subscription and trading inherent to the strategy. There's tax burdens. There's a certain amount of vulnerability that you get by having a portfolio manager that you follow along with. There's some hands-on management required, and there's a sixth bucket that I'm just going to kind of lump into as philosophical bias against this strategy of dividend investing. Argument number one against investing for dividends like I do. Dividends can and are cut on, I won't say a regular basis, but they do happen. And when a dividend is cut, it leads to an immediate reduction in income. Just as if your boss came to you and said, hey, we're going to cut your pay. It's not going to take any money away from you that you've already earned, but your future salary is going to realize a hit. And dividends can modify their dividend rates and policies and schedules at whim. They'll tell you ahead of time, and typically it's not the schedule that changes, it's the dividend rate that changes. And when a dividend rate goes down, the stock price is typically going to get whacked as well. So you get whacked in more than ways than one. And if you're thinking, hey, that dividend just got whacked, I'm going to sell my stock, well, you're going to get a whole lot back because a lot of people invested in the stock because of its dividend. This is one of the reasons why I choose to outsource my selections. The portfolio manager has a better bead on when this is going to happen more than I will, and I'm going to go into that. Argument number two against investing for dividends like I do. So there is a subscription cost. I went over it before. There's $200 a year for this model portfolio to have access to it. Big, small, depends on what your perspective is. There's also transactions involved in mirroring the portfolio. There's buys and there's sells. In my experience, I went through the history of the past decade or so that I've been doing this, and I kind of averaged it out. It's about one or two dozen transactions a year, 12 to 24. If you go on the high end, my personal brokerage, it charges me $6.95 per transaction. If I do the math on the high end, it'll get to about $170 a year. On the low end, it'll be less than that. Okay? So you add it all up, it's several $100s to actually implement this strategy.
If you subtracted the $300 or so that this is costing a year, $350, whatever it is, is that a significant impact on your yield? I guess it isn't if you're making $40,000, $50,000 a year in dividends. It
depends on the size of your portfolio.
Yeah.
It depends on the size of your portfolio.
Yeah.
As you're getting started, this is a much more significant hit. As you're towards the end, it's not really a big deal. Argument number three against investing for dividends like I do, and that's the tax burdens associated with it. So we talked about the ordinary dividends paid out by REITs. They are not tax-free. Now, ordinary dividends are not unique to a dividend-paying strategy. If you index, your index, if it's trying to cover a broad diversification of the market, the odds are it's going to incorporate companies that pay ordinary dividends. It's just a more significant factor when you're doing dividend investing because those ordinary dividends make up a greater percentage of your income than if your income is coming from an index which covers 500 stocks, maybe only 2% of those stocks pay ordinary dividends, whereas in a dividend-paying strategy, maybe 10% of your income is actually ordinary instead of qualified. So there is a tax burden there. Amongst the people here, please raise your hand if you prepare your own taxes. A lot of people. This is a huge argument against investing for MLPs. MLPs, they issue a K-1 every year. Most tax packages can deal with K-1s. The annoying thing about K-1s is that they will come late. So if you want to be the kind of guy that, I'm going to file my taxes February 15th, everything came to me, nah, you don't want to do that. You really want to wait as long as possible because the K-1s will come, and it's just a pain in the butt. And then also taxes paid on dividends pre-retirement can be substantial. Now this is one of the biggest arguments against investing in dividend-paying companies, investing for dividends in a taxable account. They'll say, oh, you don't want to invest for dividends, you want to save them for your tax-deferred account so you don't have to pay income on those dividends. It's a viable criticism, but I would say that for the people here who are focused on early retirement, I don't see that holding as much weight as that would be for somebody that's focused on the conventional retirement age. And that's because for early retirees, the accumulation/preparation phase is shorter than the execution phase, or hopefully it would be. And I would suggest that you minimize the taxes paid during the longer phase, not the shorter phase. So if you are going to be working for 20 years and then retire for 40 years, why do you want to optimize your taxes for the 20-year period and not for the 40-year period?
Since we're on the anti-strategy, I would argue, why would you want to optimize it for both? Why would you only optimize for one versus another? I mean, that would be my criticism. I have no criticism about using it as a retirement strategy, but I have a lot of criticism about using it as a pre-retirement strategy. I would equate it, I'm not a big sports fan, but I wouldn't equate it to Tom Brady in the Super Bowl. I would equate it more to playing tennis. You've been playing on a clay court, and now you're at Wimbledon, and you're going to play on grass. That, yes, it would change things. And so I would argue against holding dividends in pre-retirement. And if you actually really care about this kind of stuff, and if you don't have a lot of money, it's all true, right? But there's a bottleheads meeting tomorrow afternoon that and a lot of this same type of information is very investing specific is covered on the bottleheads site. But anyway, I would argue that I would argue that why wouldn't you optimize your taxes for 20 years and for 40 years as opposed to just picking one or the other?
I have rental properties, and I've always thought of REITs as almost equivalent to rental properties. That the rent they throw off is equivalent to the dividends, except when you have a REIT, you don't have a leaky roof. You don't have an AC that goes up. You don't have a sink that breaks.
Well, they do. You just don't. You're not the one who has to call the plumber.
You can think of a REIT as your middleman.
Yeah. You're outsourcing, basically.
Justin?
Yeah, I was thinking about the tax issue, and the thing is that the first 20 years in your example, the opportunity of the gains of those first 20 years, you also get the subsequent 40 in those as an opportunity for gains. So the impact is bigger in the first 20 than it is in the latter 40 on gains. So it's a little bit of a different opportunity type equation.
Agreed.
I really think it's just bracket. Because if you're in a higher bracket, then it would be very difficult to execute on this. Whereas if you're on a bracket where you can keep your income low, like you talked about being a consultant, doing write-offs, kind of you're an LLC almost, or a 1099 or something like that nature. It's a great strategy. It's a great strategy.
Argument number 4 against investing for dividends.
Right.
They do. So and this to me is actually probably the biggest one. There's a certain amount of vulnerability that you have from the portfolio manager role that is inherent to the model portfolio. And really the strength of the model portfolio is subject to the quality of the portfolio manager. So the portfolio that I'm following, it's had 3 managers since inception, which is pretty good. There's not a whole lot of turnover there. The vast majority of that time was one guy, his name was Josh Peters. He was running it for probably about a decade. In the past 3-5 years, there's been a succession of 2 guys. And they've been pretty steady. Different personalities, but I haven't seen a huge shift in strategy between those individuals because they are backed by Morningstar, which is a pretty well-respected financial entity. Now, amongst the people here, who likes the idea of picking stocks, individual stocks, to beat the stock market?
I did.
Not going to get a whole lot of hands there. And that's because the entire concept is really, it doesn't get a whole lot of love. And I'm included there. I do not believe in relying on stock picking to beat the stock market. But I'm not trying to beat the stock market. And I'm not trying to ask the portfolio manager to beat the stock market. What I'm asking the portfolio manager to do is to fulfill a role that's almost more akin to an auto mechanic than I am somebody to tell me the next hot stock tip. What I'm asking an auto mechanic to do is, hey, I'm looking into buying this car, used, new, whatever. You know, what's your experience with it? Oh, you like Hondas. Okay, oh, you like Accords. Okay, great. Tell me why. Okay, that's cool. I think I might actually buy it. And then once I actually own that car, I take the car back to the mechanic on a regular basis and say, how's my car doing? Am I looking at like a big bill coming up soon? Is it on its last legs? Is it looking pretty good? I'm just really looking for their advice and their expertise to tell me about the fundamentals of the car, which really translates to me in terms of stocks. What's the capacity of this company to keep on paying its dividend? What's the capacity of this company to grow its dividend? Don't tell me about what you think the stock price is going to go to, because I'm not really concerned about that. I want to know the nuts and bolts. Okay, you know, you understand, you're looking at the financial returns of this company, you're looking at the filings. How's it looking? Tell me. And then all I really want to know is from the income perspective. So the portfolio manager, if you compare it to the role that a mutual fund manager fulfills, personally, I find that kind of icky. I used to invest in mutual funds. I don't do it anymore. But while you can call it, they might have the same title, they're both portfolio managers. Personally, I'm looking to them to do different things, which to me, I can feel better about. And I can not necessarily stay awake at night concerned about this argument against. Argument number 5 against investing for dividends like I do. This is not a hands-off strategy. You must execute your own trades, so it's more complex. This is not a set it and forget it approach. Plain and simple. If this bothers you, if that's a deal breaker, this probably isn't for you. And the final argument against investing for dividends like I do, it's actually a catch-all. There's many, many arguments captured here, and I'm just going to group it all as bias. And it's not necessarily bad bias. Bias gets a bad rep. There's good bias. Bad bias, it just depends on how you approach it. Okay? So argument number 1 in terms of this bias would be, okay, this strategy sounds great. You're not going to beat the market doing this. I agree. I don't think I will. I'm not trying to. I'm not trying to beat the market. I'm not trying to beat the market. I'm not trying to beat the market.
Yeah, but what if you don't beat the market?
If you want to beat the market, don't do this. If you want to just do exactly what the market's doing, index. Just index. I'm not saying you shouldn't do it. I'm not trying to bash indexing. But my goal is to maximize income while staying within spitting distance of the market. I don't want to fall completely behind, but I don't need to be right neck and neck with the market. I really want to maximize my income, and I want to kind of balance out between the two. Obviously, leaning more towards equity. Dividend investing leads to less diversification. We talked about this a little before. Personally, I find the diversification level to be fine. You might not. I feel that a healthy enough level of diversification does not require owning everything. My personal preference. Your bias might lean in a different direction. That's fine. Dividend investing is just value investing in disguise. And you're better off just investing in value stocks. Ignore the dividend, just invest in value stocks. That's personal preference. it really depends on your goals. If you favor a higher total return, yeah, just go for value stocks. Don't focus on the dividends so much. But as I've made clear, I'm trying to maximize my income a little more, so I'm going to skew the other way. Your mileage may vary. Dividend investing is subject to survivorship bias. Is anyone familiar with survivorship bias, this concept? Essentially, survivorship bias just is basically given a certain set of circumstances, you take the survivors of those circumstances and it's imbuing them. It's basically saying those survivors, they did something right. They knew what they were doing. Well, maybe, maybe not. They might have just gotten lucky. So looking at the survivors of a certain situation and saying they did it right could lead you down to a wrong path because given another set of circumstances or the same set of circumstances in the future, they might fall flat on their face. And that's a criticism of dividend investing, basically saying, I guess, okay, those guys, they paid dividends the way they wanted to, the way they promised to for the past 10 years, but that doesn't mean they're going to be doing it for the next 20 years. I guess. Personally, I feel that every investment strategy that doesn't include every possible investment option is subject to survivorship bias. So I don't feel that this strategy is necessarily any more susceptible to it. In order to avoid survivorship bias, you would need to invest in every stock in the US stock market, every stock in every single stock market, then invest in every single option of real estate, plus precious metals, plus Bitcoin. You'd have to invest in everything to avoid survivorship bias. So I don't see why that's specific to this strategy. But to each their own. There's a better use of profits than paying out dividends. Investing in internal initiatives and acquisitions, for a company could better use their profits to invest in internal initiatives and acquisitions instead of doling it out as dividends. Maybe, but I would argue this is really dependent on the management of the company. The management has to make good choices. If the money's just sitting there, it's burning a hole in their pocket, and they really don't feel like paying out dividends, they could easily squander it on something that's an ill-advised idea. I would argue that paying out a portion of profits as dividends forces a bit of financial discipline. I disagree. Share buybacks are better than dividends. Partially because the argument can be made that the investor can choose when to recognize the income instead of having that income forced on you. And this would be more of a factor when you are pre-retirement than post-retirement, I would think. But this really depends on your priorities. Personally, I don't mind having cash given to me for free. I'm not going to argue it. Other people do. Compared to dividends, it's argued, buybacks are a more tax-efficient vehicle for returning capital to shareholders, including Warren Buffett. He says this himself. Because essentially, in order for a corporation to pay dividends, they have to first pay tax on the profits, and then the dividends come to you, which you may be taxed on as well. And I think that the tax argument is valid. I don't disagree with that. I think the tax gets a little screwed up there. But I would also argue that buybacks are frequently executed very poorly. We can go into details about that later if we wanted to. And then finally, a company that can't figure out anything better to do with their excess profits than to hand it out to shareholders isn't a company that's worth investing in. If this is your opinion, don't invest in dividends. It's really up to your personal preference and your priorities. I don't agree with that, but you might. And as preparation for this presentation, I started a discussion thread on the Mr. Money Mustache forum asking for, hey, I'm doing this presentation. Can anyone just throw out some pros and cons and questions regarding dividend investing that you really think should be included in this presentation? And this is where I got all of it. Because at a ratio of 9 to 1, at least people in that forum, they hate dividend investing. They hate it with passion. And there's plenty of arguments to be made about this. But it got to the point where I was like, am I doing something wrong? Like, should I be making like, am I not being successful? Am I just looking towards a future of poverty? But when I dig down into it, I still feel pretty good. But I do recognize that there are a lot of arguments against. And a lot of times it just comes down to, I would say, bias, which may or may not have a good reason behind it. And you are welcome to, and I can share this slide deck, and you can go to this thread yourself, and you can read all of the horrible things people have to say about dividend.
Well, you're the one retired. They may be not
Yeah,
retired.
I asked that question, but that's always kind of in the back of my mind.
So one of the things I heard even on the Choose FI podcast when somebody else was making the case, the host, one of the two, I don't remember which, said, but then you're letting the corporations decide when you get taxable income. Like it's there, you don't have that sense of control. But I mean, the counter for you is you're living off this income. If they do share buybacks, that increases the value of the rest of the shares, but it doesn't put any money in your pocket. I mean, unless it's your shares they bought back. But you get what I'm saying. It's like this is now your source of income. If you did it well, and if the Morningstar Index does it well, those, over time that income should also go up in the same way the 4% safe withdrawal rate concept anticipates.
Yep.
Yeah.
You said the newsletter was started in 2005. Have you gone back and looked at how this fared 2008, 2009 to see if that were to happen again, worst case scenario, does your income get cut in half?
Yeah, so I was invested during the Great Recession. I was following this portfolio because I started in late 2007, and I did suffer cuts. The portfolio suffered some cuts, dividend cuts. I suffered some cuts. Some of them were already seen coming, so they got out of the position. For example, it wasn't around the Great Recession, but more recently, Kinder Morgan, which might be a company you're familiar with, they were an MLP that cut their dividend. The portfolio got out of that stock before there was even a sniff of that happening. They kind of saw it coming. GE is a much more famous, more recent example. The portfolio got out of GE before GE cut their dividend, before people saw it coming. If you were going to be investing in a straight dividend-focused index, like there's like the Dividend Aristocrats Index, this is one of the reasons why I don't really think that you can index for dividends very well with this similar yield, because they're just all very metrics based. And a lot of this comes down to sitting on the conference calls, just kind of listening to the management talk and respond to the question about, hey, what's your commitment to the dividend? If they kind of hem and haw on that a little bit, well, there's some concern there, and you really got it. It's a little more nuanced than just simply black and white and looking at the metrics of it. That's my personal feeling. Any other questions? Yeah, just.
Looking at the overall approach there, it seems like you almost have to start planning very early in your process to put more of your money into a taxable account and focus on the dividend stocks in order to avoid the major tax hits of selling and moving your position to dividends at some point later. So I guess if you've already started on heavily focused on 401k, tax-deferred accounts, it almost seems like there's not really very much advantage to switching to dividends down the road.
I don't think that's dependent on whether you're deferred or not. I don't think that really factors into it, because whether or not if all of your money is in a deferred account, whether it's dividend focused or it's growth focused or it's index focused or value focused, it doesn't really matter. You still got to get it out before you're 59.5 anyway. Where that money's coming from, if it's coming from income, it's still going to land in that deferred account. It's going to be tax-free, which is good. You still got to get it out some way, versus if it's capital appreciation. I just don't see there being a whole difference. Now, with the focus on, or the question of, converting over from an index strategy to a dividend strategy, and that's basically what Alex and I were talking about before.
I would say the opposite is true, actually. All income that comes out of the deferred account is taxed as ordinary income. It doesn't matter what you did with it in that account. So if you had dividends in that account, when it came out, it would be ordinary income and it would get the same tax treatment. What you'd lose is they wouldn't be qualified anymore. It would all be ordinary income. So that's, yeah.
So you lose your.
He's asking a different question.
But you're going to lose it. But it's not particular to this strategy because you're going to lose it even if, if you bought Apple for $1 a share and now you sold it for 1,000 or whatever it is today, that capital gain, if you did it inside your 401k, it wouldn't be a capital gain. When you brought that money out, it would still be taxed as ordinary income.
I think you're asking a different question.
Yeah, that's right.
I think the question you're asking is how to prepare for when you're going to not be working anymore.
Yes.
And so the conventional way that we're all sort of been doing it is put as much as you can into the retirement accounts. And whether you have to wait till you're 59 and a half or you use some T72 rule or some other strategy to start pulling it out sooner, that's the thing, the bucket that you're going to be pulling it out when you retire. Okay. Other people are building up maybe a rental housing portfolio to create some current income, and they're going to live off of that until they tap the retirement income. So maybe people see it as buckets. And some people may build up a bigger cash portfolio to use as a bucket, maybe even use as a safety bucket for downturns. Okay. Now, what you're talking about is not the retirement, using the retirement accounts as your strategy for retiring. You're talking about building up in your, and you said it, in your taxable accounts, enough money, and that's what Mr. Money Mustache did. Building up enough money that you can live off that portfolio. Now the argument is, how do you construct the portfolio? And you've chosen to construct it in a way that you don't have to touch the principal, so to speak, the actual shares. You just harvest the dividends themselves, and you learn to live within the amount of money the dividends pay you, be it bad or good or bad. Hopefully they're going to rise over time. If there's a bad year and some of them cut and you don't adjust your portfolio in time, then you're just going to live on less. And you probably have your own cushion somehow in order to deal with that. But that's really what you're asking, is the strategy of, when I go to pull the plug, what's there to support me?
Exactly.
And
you have to make your decision what direction you're going kind of early.
Yeah, exactly. What Mr. Money Mustache is, he built up a huge portfolio. You built up a huge portfolio. You had a high savings rate, independent of what you put into retirement. You had a high savings rate into after tax. To hit a point, you said, and cut your expenses, and said, I can live off of this. I'm done. Bye. See you later. Right?
On the other hand, bad financials also show you how to get the money out of your tax deferred account before you're 59 and a half.
You still have to wait 5 years every time you do it.
Unless you have a Roth or any version of change.
Yeah.
You can still pull those out.
Right. I mean,
if you don't have a Roth.
But I was clarifying what you were really asking.
Right. But you are asking a different
question.
Yeah, I mean, just if you were, Joe By person that, you might be on day 1, and you might be on year 10, you might be on year 20. If you're all, on day 1, you can choose whichever path you want, and there's no real negative consequence. If you're on year 10, you've got 10 years of accumulation in different pots, and shifting that around is going to cost you a lot of money in taxes. And if you're on year 20, you might go broke trying to shift your strategy around. So, my point is, if you're going to make the decision, you almost have to decide very early or in the middle, and then just build a new profile on top of what you've already got existing.
Dan?
Yeah. If you find that your dividends continue to increase, such that you've got more income coming in than you need, will you increase your standard of living, or will you just save more?
Depends on what she says.
That's part of the beauty. That's part of the beauty of a dividend, generating portfolio like this. It gives you more options. You're not stuck at a certain income level for life, and that's just hope for the best. It just grows over time.
But
I didn't hear you say anything about preferred stocks. I'm just curious if those are on your radar at all.
Me personally, no. At one point in time, the model portfolio did go into preferred stocks a little bit. It was temporary, it didn't last very long. So I kind of go along with the
You
ride for
mainly
that.
just follow the model portfolio.
Yeah. I don't know enough about preferred stocks to feel comfortable to branch out into it on my own, so I would kind of follow along with recommendations made. And typically it comes down to, we're not finding enough different options based on the more traditional universe that we're used to. Let's look over here a little bit, and that's really when it has happened in the past. But currently the portfolio does not hold any preferred stocks.
So what happens when you're...
Hold on, you didn't raise your hand.
Yeah, come on, admin.
So did you also do 401k and IRAs also? Is that part of your safety net?
Yeah, so my personal history is that before I got into the entire FI FIRE thing, I was investing, I had an individual 401k and a SEP IRA, which were available to me because I had my own corporation, which is great. And I was pumping a lot of money into them. Then I went through a divorce, and as part of the divorce, I lost half of everything. And I basically gave her the tax advantaged accounts for simplicity because she just wasn't as interested in financial management as I was. So I took on the taxable accounts. I gave her the tax deferred accounts, which worked out well in light of my financial independent leanings, which sprouted right around that time. And I did the math, and it's like, hey, I think I could actually do this way earlier than 59 and a half. Oh, that's cool. So at that point, I really just started pumping money into the taxable account 100%. And I just kind of left whatever small amounts I had, relatively small amounts, in the deferred account, just to kind of grow. I do have a Roth account. I do have a traditional IRA, but they're much smaller, and I don't actively invest in them anymore. But that money is going to be a great safety net, when actually I finally do retire age.
So your IRAs, do you just do like mutual funds? Or?
No, I actually invest the same way.
Same way.
Dividend paying stocks. Let me just finish up. Oh, hold on. Let me just finish up. I have one slide.
In conclusion.
Next slide, please. In closing, dividend investing is a viable option for investing in the stock market, either in concert with total market indexing or instead of it. Your choice. As before, I am not trying to discredit total market indexing. I think it's fine. If at some point I decide, hey, this dividend stuff, I'm not really cool with it anymore, I'd be fine going with total market indexing, drawing down some capital. Everything says that it should work fine. It's just not what I'm choosing to do right now. And I would hope that after listening to this, you see that you actually have an option too. Okay. So the Morningstar Dividend Investor newsletter, it offers a 30-day free trial. If you find this appealing, you can give it a try yourself. The subscription also includes access to something called the Morningstar Guide to Dividend Investing, which I found, I haven't read it recently, but when I did get first started, I found it to be a pretty valuable tutorial on some of this stuff, more in depth than what I'm talking to you right now, much more into the nuts and bolts. And that's it. It's been great to be with you today. I very much enjoyed it. And if you have any interest, at some point, the slides here, they don't really capture a ton of what I was speaking to here. I do plan to write up this presentation in some form as an article on my blog. I don't know when that's going to be. I don't write very often. It's maybe like a handful of articles a year. If you're very interested in seeing it when actually I do write this up, my best suggestion is just go to my website, go to the blog, subscribe to the blog, and then you will see when actually I publish that. And that's it. Now, Alex, your question.
So what happens if your income is higher than that threshold for tax? Is it a cliff or is it?
No, so it's a marginal. So you would pay tax on the portion that goes above that.
Okay.
Same as capital gains.
Alex, I answered your question by posting on the website, or on the Facebook page.
Okay.
So I put a post on from Engaging Data that it's a visual representation of how marginal tax rates work and how this specific scenario works that we were talking about for a single person qualified dividends / long-term capital gains. So you can, it's a very, the website's not 100% accurate, but in terms of being 99% directionally correct about how taxes work and how your situation would change, it's very interesting to look at, and people have found it very illustrative.
And I might have missed that when you were doing your presentation. So when you were working, and as you were building a portfolio when you're working, what tax rate were you taxed on the dividends? Was it 15% qualified dividend rate, or was it your income rate?
Yeah, it certainly wasn't zero. The thing was, when I was working, I didn't pay nearly as much attention to taxes. So I've always had my taxes prepared. That might change in the future. Partially it's because I have personal taxes and corporate taxes. And I've never had time to really focus on it too much. All I know is I was paying a ton of taxes. You know? And that's not just because of investment income, that's just because, you know, some years I was doing really well, some years not as well. But in those years, you know, it all kind of got lumped together. So the actual rate, if you're in the 22% bracket, you know, you're paying 50% on your dividends, I believe. But that's the same as long-term capital gains.
Mm-hmm.
So it's something to consider, but it's not something that I could rattle off the top of my head. Yeah, Matt?
Hey, Mike, on the slide where you had your 6-month income, you know, you had 1 month, let's say 4,000, another month at 1,200.
Mm-hmm.
Do you attribute that to the market price share, or do you attribute that to dividend cuts?
No. So that's just the fluctuation. So because every company pays on its own schedule, it might be that out of those 30 stocks, maybe 20 of them happen to pay in September, and only 10 of them happen to pay in October. So if you've got less sources of dividends coming in October, well, your payments are going to go down. It's just the fluctuation. It's not a monthly payment. It's typically once every 3 months. So if they get lumped together in 1 month, that's just happenstance. It's not because performance is going back down or anything like that.
Maryland taxes.
Yep.
While we're on taxes.
Yes.
So how does that work for you? Do you have to be prepaid at all throughout the quarter? Like, guys, you get that money quarterly just to be fed, or is it a lot lower tax rates?
Yeah, so for last year, which is my first year doing taxes post-retirement, it was educational. So I paid 0 on feds, which is great. I did pay several $1,000s on Maryland. And a lot of, that's not including property tax. Property tax is separate. But yeah, Maryland does tax on your.
There's no special treatment for a dividend or a capital gains in Maryland. It's all considered income.
Yeah, they basically just take a percent. It's based on, whereas your.
It's complicated.
Yeah, it's complicated. And I can't rattle a lot of it off the top of my head. But it was instructive to me. It's like, oh wow, this is why people move. But I don't think that it's so burdensome that I'm ready to sell the house. But it is something that I need to keep in mind. And it was when you factor in property taxes, you got the state tax, you got the local tax, it adds up. And it's something that you don't want to get surprised by. But it's not so much that I feel like it's going to torpedo the entire tax bill.
But you're not prepaying at all through the quarters?
Well, because it really, when on the Fed level, the safe harbor is as long as you're paying 100% of what you paid last year, which was 0 for me, I don't have to worry about it. But because I did owe tax in Maryland last year, I think the safe harbor is 110%. Because it's hard to know exactly what the capital gains are going to shape up, And that's really the variable here. I can predict pretty well the income I'm going to get from the dividends. That's going to stay fairly stable over a year. It's going to go up a little bit, but it's not going to change that much. But the capital gains, if I have a position that I've held for 10 years and the model portfolio says, hey, we're going to sell out of this because we think the dividend's going to get cut, okay, I got to look at that and say, like, wow, if I sell that right now, I've gone up 300% on that stock for the course of the past decade. If I sell, I'm going to get a big capital gain. And I want to try to figure out, okay, that might blow me past any kind of 0% income threshold for the year. Wow, that kind of sucks. But as long as I know it's coming, I think my first accountant said to me, you're never going to go broke paying taxes. I guess, but it still sucks. Did I answer your question? Yeah.
What do you do for health insurance? Because I think that's one of the biggest
Yeah.
deals. When you tell people about early retirement, the first thing they say, well, this Affordable Care Act could be health insurance. You got to do a job. You're going to have to spend thousands in out-of-pocket expenses if something happens. Because most people like me don't know anything about health insurance because we just get really good insurance through our job, and we just sign up for it, check a box, and you just get it. So if you retire, you have to
take care of yourself.
Go to the health exchange thing and find something that compares to your job, and can you get that based on if you're in that whatever lower income bracket that you wouldn't pay so much for it. If you don't make high income, if you're whatever you're at 39,000, probably still qualify for pretty affordable health insurance through the Affordable Care Act. So I was wondering what you do.
Okay. So before I answer that question, does anyone else have a question about dividend investing? Because this could go into a completely different. No, that's fine. That's fine. Okay.
Let's finish with dividend investing.
Thank you very much. Okay, so as far as health insurance, so I feel that I was in a fortunate position relative to that going into retirement because as a self-employed individual, so I have a company, I have a corporation, I employ myself, and ever since I've been divorced, which has been quite a while now, I've been self-insured. So it used to be that, okay, I could just be on my way with insurance. Great. But as soon as that went away, I had to take care of my own insurance. So I've been on the exchange ever since the ACA came around. So I am going to MarylandHealthConnection.com and I'm filling out the forms and I'm actually getting my health insurance that way. And I feel like that has been a benefit to me because as you transition from pre-retirement to post-retirement, there are things that are going to change. And personally, my approach was I want as few things to change as possible from pre-retirement to post-retirement because it's stressful and I want to have all the knowns figured out as much as I can. Taxes, like, okay, I don't do my own taxes, so I really got to get a little closer to this, and I tried to figure it out, and I did okay. Health insurance, because I was going from ACA to ACA, the same thing, I kept the same plan, okay, that's cool. But the thing that helps is that as your income goes down, the new thing for me was, subsidies. Like, I actually can be eligible for some subsidies here. But whereas Alex asked about, as you earn more income, as soon as you get above a certain threshold, is everything taxable or is only some of it taxable? Well, it's a marginal tax rate, so that means only the part of it that goes above the threshold gets taxed. In terms of healthcare and subsidies, that's actually something that's more of a cliff. As soon as you go above 400% of the poverty level, then you lose every subsidy. Like you basically go from, like I think my subsidy was somewhere in the hundreds. It was probably like, I don't know, $800 or something. But as soon as you go above, like if you get to 401% of the poverty level, the $800 goes away. Which, when you're talking about, $38,000, $39,000, $40,000 a year, it's actually something that's kind of sizable. That actually makes a bit of a difference. But I feel like I'm going to be better at it for next year. I'll understand it a little better. I didn't do anything that really shot myself in the foot, I don't think. You know, I think I now understand where I've always gone for like the bronze health plans with the astronomically high deductible. Now I'm realizing, hey, actually it might behoove me to actually focus more on the silver plan because the subsidies actually could actually even out to be a little better. There's a learning curve there. And if you've never gone with a marketplace plan, it could be a shock. And I think that is the number one reason why people do not retire. If you read on the forums in any place, everyone just stresses up the wazoo about health insurance. And I think that's valid. I really think that it's valid. It's such a question mark. The ACA is still the viability of it and the survivor, if it's actually going to be around next week, next month, next year. Who knows? It's survived this long, but it's hard to say.
What is that amount you can make and still get?
I don't know it off the top of my head. I do not know. It's going to shift. And the problem is, like, I tried to figure this out ahead of time, and to get the numbers is really hard. There's a few calculators online, and you can plug in the numbers, but you kind of get different results. And then on the Mr. Money Mustache forum, and I think also on the Bogleheads, there's a spreadsheet that floats around. It's by this, at least on the Money Triple M forum, he's like MDM, the MDM spreadsheet. And it actually incorporates ACA subsidies. So it's like, okay, that's another source. So I got a couple different online calculators. I got this spreadsheet, and I kind of just plugged in all my numbers. It's like, okay, it could be this or it could be this. I'm not exactly sure what I'm going to get. And then a lot of it's based on the second lowest cost silver plan available to you.
Right.
It's like, okay, that's cool. What is that? And to find that number ahead of time, it's really hard. By the time you get into, you know, your tax prep year, after you get past the year, you're going to get a filing from, it's either Maryland or it's CareFirst. I don't know who submits it. But then you're going to see, okay, here's the second lowest cost silver plan. Great, I wish I had that 5 months ago, but it's hard to get those numbers. It's not real perfect from a tax optimization perspective.
So what is yours cost?
My insurance?
Insurance, yeah.
I think it's in the high 300s. And that actually went down because the year before it was really bad. But then Maryland actually did some good steps in order to get that health insurance down. So it ain't cheap, but...
That's a good subsidy I think you're getting though.
No, that's pre-subsidy.
Oh, it's pre-subsidy?
That's pre-subsidy, so
Okay.
it's actually lower than that.
Okay.
That's my out-of-pocket. So my strategy is, when you go to Maryland Health Connection, you can estimate your income, and it'll tell you whether or not you qualify for subsidies, which is great. But I like to err on the side of caution. I like to overestimate my income so that I don't earn any subsidies throughout the year, and if it turns out that I earn less, I'm going to get money back. Because I don't want to owe money at tax time. I'd rather get some money back. Because I don't want to be surprised and be put into a position where, oh crap, I actually need to pull money out from somewhere to pay off.
And that's at the federal level you're talking
Federal,
about?
this is
Yeah.
all federal.
Yeah.
Right, okay, so if you just retire, the cost will probably be a lot, and then the next year when your income drops and having no money, no income, hardly any income, or less income, it would go to the insurance cost.
Yeah, there's two, I can't remember, I don't know all the stuff off the top of my head, but there's a cost sharing subsidy and then there's something else. And
Premium
subsidies, and they kind of combine to help defray your costs.
Yeah.
And it can be very lucrative. If you really get your income down really, really low, especially if you're married, it could really wipe out a tremendous portion of your premiums.
So if you get it too low, you could fall into the Medicaid bucket.
Medicaid bucket.
So there's sort of a, again, in terms of planning, there's a, like, you want to be above, unless you want to be on Medicaid, you want to be in a certain level above that in income to qualify for the subsidies, but not too high. So yeah, it's complicated. I mean, You
150
talk-
to 200% of the federal poverty level is the sweet spot.
So you talk about how much time you spend on your dividend strategy. You might be spending more time on your health insurance planning than you are on your dividends.
Yeah, I get dividends. Like,
Yeah.
this makes sense to me. I've been doing it for a long time. But figuring out health insurance subsidies, that's new to me. And it's changing.
This is a pretty often asked question all over any fireplace on the internet. So there are entire blog discussions to this. The subsidy is tied to the income. His strategy is a good income for paying no taxes and illustrates the difference between cash flow and income. The main competitor to ACA Exchange is something called Healthcare Ministries, which, if you have pre-existing conditions, can turn you down.
Also, they're not very good at actually paying
They're
Okay. terrible at
Well, I've heard different things depending on which one. I haven't done it myself, and I'm going to go on Cobra first. But and I'm actually, as an owner, I have some say. Unfortunately, not a majority say, but I'm trying to convince the company to carry Cobra to your 65. So at least we can participate in the plan. But leaving that part aside, I've heard some okay things about Liberty. Okay. All right. Your actual experience is better than what I've heard. All right. But anyway,
Yeah.
a lot of these, because it's a really big
So that's why I'm worried of giving up like full-time status, because I don't want to have to spend time thinking about competing with things like health insurance.
Right. And then the third option is to work at some place like Starbucks or Home Depot. There are about 15 companies that give health insurance to people who work 20 hours a week.
Oh, yeah.
But you have to work enough. It is slightly more than half time that you have to work.
Okay.
Consistently over the course of the year. Like each quarter, you're qualifying based on whether you have enough hours. Yeah.
And on that one, most Home Depot cut it when the ACA came out.
And
They pushed everyone to the ACA.
The plan for part-timers, at least at Costco, because I dug deep into their documents, was not as good as the plan for the full-timers. So it's more expensive with less benefits. Which, I mean, is understandable. I'm not even being critical. I'm just saying, read the fine print.
What are some of your best strategies for keeping your expenses low at this point?
She's just going to give me 30 minutes and go into too much. So, this is my phone. This is my phone. Okay, it has a rubber band around it. I can technically text on it. But this is why I say do not text me.
CCC, right? Yeah.
Do not text me because I don't want to have to respond to you because it's going to cost me money to respond to you and it's going to be slow for me to respond to you. I do have this. It's a phone, but I don't use it as a phone. It has no phone plan. I use it really just for taking notes, more for travel, for mapping and what have you. This has no plan. There's no ongoing cost. I paid, I think, $60 for this. It's an Android. We do not have cable. We do not have Netflix. We do not have any kind of streaming service. We watch DVDs from the library. We keep our house colder than she would prefer, hotter than we prefer. We turned on the air conditioning once this summer when it got into the high 90s and 100s, and I kind of bitched and complained about it.
Put on another fan.
You can only move that hot air around so much. It's the same hot air you're moving around.
When we go to lunch later on, I will not order anything.
Yeah.
And it's not necessarily because I just don't want to spend money. It's just for other reasons.
But
Partially,
partially.
that factors into it. We travel a good amount.
twice a year.
At least twice a year. And we went to France last year for a couple of weeks. We're going to Hawaii next year. So we do spend up for that. But for Hawaii, the flights are all on points.
Really?
On a really low number of points. You can look at my blog for how I did that. We stay at Airbnbs as much as possible. And not just Airbnbs, but Airbnbs where the owner is present a lot of the times. because a lot of people find that icky, but we're okay with it. We have met some really nice hosts, and you can get things for typically a lot cheaper. For car rentals, there's a site called AutoSlash that's really good at finding car rental rates. And they will actually update you if they find better deals in between the time you booked and when the time you actually got the car rental. There's a lot. I bike around a lot. I carpool to FI meetups. Biking is actually my primary mode of transportation. It kind of goes on and on and on. So there's a lot of different ways that I focus on trying to live frugally.
Being such a minimalist, how do you get points to be able to use, or how do you wind up getting them to be able to use them?
So everyone, typically in the fire community, everyone has something that they can't not spend money on. Whether you're an audiophile, or you're big into cars, or you're big into travel, or what have you. Mine is food. I spend a lot of money on food. And it's not even eating out. I just eat a large amount of high quality food. So I shop at Mom's, I get grass-fed, pasture-raised, what have you, and that's not cheap. So typically if I need to put a lot of spend on a credit card, I will go and I buy my weekly allocation of food just for me, which tends to be a lot of money, and then I'll buy a $100, $200, $300 gift card along with it. So right now, for the past several months, I've just been shopping on gift cards that I bought in the first half of the year because I was trying to get to a bonus on a credit card. It was easier when I was working. Now, it can be a little tough. But if I've got some big expenses coming up, I might have my CSA share re-up coming, that'll be several $100s right there if I'm paying my tax preparation or if I'm paying for a trip. Those are some big expenses that I try to plan for. It's like, okay, I'm going to be spending $400 soon. Can I sign up for a credit card?
Is there a website you can follow to tell you which credit card?
Yeah, I mean, there's various blogs you can follow that kind of. I mean, there's lots of also shadier ways to manufacture spending. I don't really go towards that. The buying gift cards is probably as close as I get. But those gift cards I'm buying along with something else. It's not just a big gift card buy from giftcards.com. It just happens to be where I shop anyway.
What did you do as a contractor before you decided to retire?
So I was a software developer, like Bob. I did that for ever since I got out of college. I did that for a long time. And basically I was in software development on a contract basis throughout the area. Typically, I lived fairly local. I live in Cockeysville, so I typically worked anywhere between Towson and Sparks. So I tried to keep myself local even then. And I enjoyed it. It was actually not an easy decision to leave. It wasn't like I was trying to get out as soon as possible. It was just because I want to do other things with my time. I don't have enough time to do them. What can I sacrifice? I guess I'll sacrifice my job. Because that's 40 to 60 hours a week that I could be doing something else with.
Do you work?
I work from home, so
Okay.
we're under the same roof all day. Which
How's that working out for you?
He's downstairs, I'm upstairs. Send him away.
Another tip, before you plan on retiring, make sure that your significant other is very much on board with that before you do it. Lesson learned.
Not gonna quit.
He would hate it. All right, I'm ready. But I'm happy for him.
It's been a year and a half. We're still together. Anything else?
Have you considered going a little bit part-time, like do 10 hours, 20 hours for anyone just to,
So far, no. Definitely not in the first year because I was approaching that first year as an experiment. So I wanted to keep that experiment as clean as possible. And that meant no income. Now that I have gone beyond that first year, I'm more open to it. But at this point, I haven't seriously considered it. I wouldn't do it because of financial reasons yet. and I wouldn't do it because I'm bored, because I'm busy. Somehow I keep myself very busy. But at some point, I could imagine doing that. Like I said, I'm big into shopping at Mom's. I like Mom's. I can imagine going to work at Mom's. That would be fun. Because partially, that would give me a 30% discount on groceries. And I think the produce can actually be free. I spend a lot of produce. So I can imagine doing that at some point. But right now, it's not something I'm too interested in.
So one time, $60 for that cell phone, and you get data.
Oh wait, so this thing costs $60, I'm sure. This is an Android phone. It's a blue phone. It was really cheap. I got it for Christmas actually, so I got it as a gift.
You got it off eBay.
Bought it off eBay. It was a used Christmas gift. So I actually have a SIM card in here, but it's an international SIM card. So this actually is more for travel than anything else. For when we're driving around, and I use Maps.me for getting GPS directions. I use Evernote for my note-taking, my travel itinerary. I can always look it up. But for making calls, it would really be just for emergencies or something like that.
One last, if I remember from the first time when Dan was speaking, did you say you do financial coaching on the side? And if you do, what kind?
No, I haven't done any coaching. I don't want to steal his thunder because he does coaching. I'd be happy to help anybody out. The closest I got was I recently served as a fire expert at a seminar at Johns Hopkins Carey Business School. They had a class, and I was asked to serve on a 3-person panel, which is great. And that was enjoyable. And that's actually the only income I realized this year. I got a small stipend for doing that. And I'll do that. I like talking.
So thank you very much, Mike, for the time. And again, like lunch would be in let's transition out here and get lunch. Maybe before we all leave, maybe we can go take a picture outside, get together. And the lunch place is at R&R Takiera, which is about 3 blocks down south. And I can post that online as we head out. So.